What are the linking methods used with IUL? Welcome, this is episode 9 of our Secrets to a Tax-Free Growth series. Last episode, we went over what it means to lock in and reset with an IUL. Essentially, in recap, what that is when we make gains, so if we had $1 million, we made 10%, and that $100,000 gets credited back to our account, now we have $1.1 million, and that is now newly protected principal. Next year, if the market goes down, we have that completely protected. Now, that is only if we did a 1-year point-to-point option. What that means is if the option we bought was only a 1-year point-to-point, then it gets credited back to us at the end of 1 year. Now we're going to get into, there's actually a couple different types of indexing. So there's 2-year point-to-points, there's 5-year point-to-points, there's monthly point-to-points, there's multipliers, there's spreads, there's participation rates, there's dollar cost averaging. We're going to get into all of this today. This isn't the most important video when it comes to understanding your IUL, but I am going to quickly highlight those and then at the end explain why this is still semi-important for flexibility and how this kind of affects your policy over a 20-30 year time horizon. So let's get into that now. So in our 1-year point-to-point indexes, what's important to note is we have the floor of 0% like we went over last video, and we also have our cap. So let's say our cap is 10%. What this means is if the market were to do 20% in that year, the S&P 500 gained 20%, we would only get up to the cap of 10%. The trade-off for that, of course, is if the market goes down, we have the downside protection, we would do 0%, we wouldn't lose anything. So if you were wondering, okay, there is 2-year, there is 5-year point-to-points, but why would I ever even use something like that? It's exactly that. Is these 2-year, these 5-year options, because they reset less frequently, they're gonna have higher cap rates. So let's say it's a 2-year point-to-point with a 20% cap. Well, if the market does 20% this year and then down 3% the next year, if you were just in 2 1-year point-to-points, you would have gained 10 and then lost 0. So still pretty good. If you were in the 2-year point-to-point, you would have gained the 20 and lost the 3, which obviously averages out higher than gaining 10 and losing nothing. So this is just kind of a small way of diversifying. Now the 5-year is similar. Maybe the 5-year is uncapped. Let's assume this one is. Aside from just diversifying, which is the main reason these things are important, is let's say you are someone who does like to keep an eye on the market and you see something like 2008 happens or the Great Depression happens. The market just dropped 30 or 40%. You say, hey, I don't like to time the market, but I do think over, I don't know if it's gonna be next year, the next 2 years, the next 3 years, but over the next 5 years, I expect there to be some form of correction. So I'm gonna go ahead and link to a 5-year index with this uncapped rate, because at some point over this 5 years, I really feel like the market's gonna go up. And if for whatever reason it kept going down for the next 5 years, I'm still protected with my floor. So that tends to be the most common time of when we see people linking to a 5-year index is right after those crashes, because they say, oh, maybe I think the market's gonna correct soon. Let's go ahead and link to a 5-year point-to-point. So hopefully we can take advantage of that correction. Now, if you're someone who does not want any part in that, that's totally fine. It's still good to know about these things because they are forms of diversification. There's also, of course, other indexes than just the S&P 500, but for example's sake, in explaining all these different types of indexes, we're just gonna stick with the S&P. Now, the next type of indexing strategy that some people will use, and not all companies have this, but some do, they're called multipliers. And what that is, if you can remember back to how we described these options actually being bought, is let's say if the $1 million in cash value, the insurance company credits you $40,000. You then put that $40,000 in an option, let's say it's a 1-year point-to-point. If you wanted to, let's say you had a couple good years in a row, or for whatever reason you just want to increase your earning potential, what you could do is say, I know I was only gonna put the $40,000 over there in the option, but instead I'm actually gonna be willing to put another $40,000 of my own into that option to put, let's say it's a 2x multiplier on that. It's considered a 2x multiplier, meaning it'll double, but really all that's happening is you're just putting some of your own cash value towards that option. So this is a way, again, if you are someone who watches the markets and you're saying, hey, something bad just happened, I really think this next year, this next 1 year, the market might do really well, so I want to put a little bit more in or at risk. And even if I lose, hey, I only lost 4% of my money while everyone else maybe lost a bunch, I'm willing to take that risk. That's an option you have as well. So there's the 1-year point-to-point, the 2-year point-to-point, the 5-year point-to-point. There's also monthly, we didn't touch on those. And then we just went into the multipliers of how you can still use those different point-to-point methods, but also include some of your cash value in if you wanted the chance for some higher returns. Now next, these might actually seem pretty similar to multipliers. They aren't the same thing, but that's called participation rates. And the easiest way to explain that is the participation rate is the percentage that we're going to multiply our return by. So if the S&P 500, we had our 0% floor and our 10% cap, the market gains 10%, we got the full 10%. So what percentage of 10% did we get? Well, we got 100% of the 10%. So in that case, we would have had a 100% participation rate. Now, some indexes, what they might do is say, okay, you have that cap of 10%, but we're going to give you a participation rate of 150%. That means if the market does 10, we're going to give you 15%. If the market does 5%, we're going to credit you 7.5%. Obviously, those come with some trade-offs. Maybe it's a lower cap. The other things some indexes will have, and they're going to function by index, but are called spreads. So they're going to say, instead of giving you a 10% cap, we're going to give you a 15% cap, but we're going to charge you 1% for it. So if the market does 5%, you're only going to get 4%. So in the case where it doesn't go really high and you don't get to take full advantage of that, you're going to lose a percentage point there. And last but not least, what we have here is dollar cost averaging. Essentially, all this is I'm just going to use the 1 year point-to-point example. Instead of linking all of your money to a 1 year point-to-point index on January 1st, for example. So if you had the $1 million and you're going to say, I want to put it in that account that has the 10% cap with the 0% floor and resets in 1 year. Instead of doing that, you can say, I'm going to take 1/12 of my 1 million and link it at the start of each month. So instead of linking all your money at the start of the year, you can spread out when you link your money. So your 1 year point to point start in different months. It's just another way to diversify and protect against single bad months. And that's exactly what this video is about. Is it possible that the 1 year, the 2 year, the 5 year point to point methods are perhaps better than other methods? Maybe. Are some over a 100-year period going to perform better than others? Perhaps. The point is, whether it's those standard indexes, whether it's one with multipliers, is that we have flexibility. So when it does come time for annual reviews, for other times you'd like to meet, we have all of these different indexes that we can look at. If you are someone who looks at the market, you're able to do that and make adjustments based on it. And it gives us more ways to diversify. You can come to a simple annual review and say something is, Daniel, what are you doing in your own personal IUL? If this was your IUL, what would you do? I actually really think that the market just went down, so I want to link to this 5 year point-to-point index. Can I do that, Daniel? Yes, you could. Overall, if there's one thing you're going to take away from this video, it's that you have a lot of options. Most people are just going to stick to your 1 year point-to-point in the S&P 500, leave it at that, and they'll keep that until the life of the policy. The main thing that's nice about all of this, even if you are someone that's going to do that, is you have flexibility not only at our annual reviews, but whenever you want to make those changes. Sometimes, and we're always going to go with an insurance company that treats older policyholders well, what they'll do is they might add in a new index that has some nice perks for the next couple of years that you can take advantage of, and they're doing that out of good faith, showing you, hey, we still do care about older policyholders. Maybe there's another form of the S&P where they're going to raise the cap on another index, and you would still be fine staying in the S&P index that you're in right now, but the high cap S&P index, for example, they just raised the cap much higher than it used to be, so you could get in on that at least for the time being, and if they were to lower it down later, you could always hop back into the regular S&P. All of this varies by company, it varies by product, but now you have the option to rebalance your portfolio when you'd like to. Next video, now that we have this out of the way, a little bit more technical episode, this last one, we're going to get into my cash value started to grow now. How can I access my money if I want to use it for my retirement income, if I want to use it to fund a business? How do we get the money out? I will see you in the next video. Bye-bye.